Hello learner, welcome to this session on investment decision, that is capital budgeting. This is the fifth session on capital budgeting, that is investment decision. In this session, we will be having extensive practice about different methods which we have learned. Like we learned different methods, payback period method, ARR method, NPV method and so on. All those methods we will practice, and more importantly, we will practice at the end of this session one numerical on replacement decision. That means if a company has to replace the old machine with the new one, old technology with the new one, then how the feasibility has to be checked out, particularly the financial feasibility with the help of capital budgeting method. So that will be the last part or last important question in this video. So let us begin this video. In this video, first we will have a recap of the things which we have covered in the previous methods or previous video, and then we will practice a numerical. Now if you see investment appraisal methods, we had categorized the methods into two groups: non-discounted cash flow method and discounted cash flow method. Non-discounted cash flow methods are the one in which time value of money is not considered. That means absolute amount value or monetary value is considered for evaluation. And in this category we have payback period method and ARR, that is accounting rate of return or average rate of return. ARR method is also known as return on investment method. Then we had discussed about discounted cash flow methods. That means such methods in which time value of money is considered. As we know, value of money changes with the passage of time. Therefore, in these methods we consider time value of money, and these methods are in generally considered superior than non-discounted cash flow methods. However, it is up to the finance executive or the business policy which method to apply, because none of the method is perfect in itself or none of the method is poor in itself. So, but in general, if you ask me, discounted cash flow methods are more logical as compared to the non-discounted cash flow methods. In that we have three prominent methods: NPV method, profitability index method, also known as benefit cost ratio method, and IRR, internal rate of return. However, there are other methods which we can discuss at some other platform or in other course, but in this course only these 5 methods are discussed. Now then comes, while applying any of the methods which we have discussed, whether discounted cash flow methods or non-discounted cash flow methods, these are the steps we have to take. Step number 1, estimate the cash flow or cash outflow, because cash flow means cash inflow as well as cash outflow. So cash outflow means investment in the project. Generally, in majority of the numericals, it is initial cash outflow. That means how much investment will be done at zero time in the beginning of the project. Initial investment may be on 2 activities or on 2 aspects: fixed assets, that is land, building, plant, machinery. If these are purchased by the business organization, they will have to incur the cash outflow or investment. At the same time, we might require some funds for the working capital. That means requirement of the funds for day-to-day expenses, day-to-day activities. So that will be generally initial cash outflow. However, in certain cases, when company goes for the expansion of the activities, then subsequent cash outflow might also be there during the lifetime of the project. Subsequent cash outflow can either be on fixed assets, on working capital, or on both. It depends upon the scenario. So in total, cash outflow will be like this. So first step is estimate the cash outflow. Then second step is estimating the cash inflow. There is a difference between cash inflow and the profit after tax, which we have discussed at this detail or in detail in the previous video. However, a recap is there. Cash inflow may be of 2 types: operating cash inflow and terminal cash inflow. Operating cash inflow means the cash inflow resulting from the operating activities of the business. And as you know, operating activities of the business are simply buying the goods, selling the goods if it is a trading business, Whereas if it is an industry or manufacturing business, definitely buying the raw material, processing it and then selling it. Whereas in case of service industry, it will be procuring some material to provide the service and then providing the services, so service revenue. So all that put together results into operating cash inflow. That means how much cash inflow project will generate year on year during its lifetime from the core activities of buying and selling of the goods and services. So those are operating cash inflows, and you can see this is the way we calculate operating cash inflow. However, detailed method of calculation has been discussed in the earlier video. Then terminal cash inflow. As name suggests, terminal means the cash inflow which will come only when project is terminated, project comes to an end, and it might comprise of two things: salvage value, that means value realized by selling the old assets or used assets, and this has to be after tax salvage value. That treatment of tax has already been discussed in the previous video. And recovery of working capital. Whatever amount might have been invested in the project, either initially or subsequently for working capital, that gets recovered as soon as project comes to an end. So this is the way recovery of working capital takes place in the form of terminal cash inflow. So that is the second step, estimation of cash inflow. Now, once we have those two steps, third step will be there, applying the method, whatever method is given to you in the examination. It may be discounted cash flow method or non-discounted. So let us practice on those methods by following logical steps. My only submission is that never make a shortcut. Reason being, if you make a shortcut and some twist might be there in the language of numerical, and then you end up having wrong answer. So only idea is that follow the steps, estimate the cash outflow, estimate the cash inflow, and then apply the method, whatever method it may be. So let us read this numerical. Initial investment in a project is rupees 4 lakh in fixed assets and 2 lakh in working capital. So you can see initial investment is total 6 lakhs, 4 lakh in fixed assets, it may be land, building, plant and machinery. However, just to remind you, land is not subject to depreciation, so we never apply depreciation on land. However, on rest of the assets, yes, we apply the depreciation. So nothing is specified, so we assume these are depreciable assets. Project will generate following operating cash flow. So pay the attention to the wording of the numerical. We are given operating cash flow. It means completely we are given these values are regular cash inflow or operating cash inflow. Years are 5, so implied life of the project is 5 years, and these are the operating cash inflow. It means the examiner has given you exactly profit after tax plus depreciation value. So in this question, you need not to calculate depreciation for the purpose of solving this numerical, because that is not required right now. Then what method we have to apply? We have to apply payback period method, ARR method, NPV and profitability index. So it depends. When we come to the ARR method, yes, we will use the depreciation for the calculation of profit after tax. But for payback, NPV and PI, we need not to adjust depreciation anywhere in this numerical. So now let us take the logical steps. Initial cash outflow. That means in the beginning, project requires 6 lakh rupees investment, an investment of rupees 6 lakh. 4 lakh in the fixed assets and 2 lakh in the working capital. Operating cash inflow is given as such, no other calculation is required. Then terminal cash inflow, which will comprise of salvage value as well as recovery of working capital. So what is the salvage value? 50,000. It means out of 4 lakh, 3 lakh 50,000 might have been depreciated or amortized over the 5 years period. So terminal cash inflow will be salvage value 50,000. That means sales value of the used assets. Now this salvage value of 50,000 can be considered as after tax. Normally, if nothing is given in the numerical, we assume whatever salvage value is given, that was equal to the book value, and hence there is no requirement of tax treatment. Then recovery of working capital. That means whatever funds have been blocked into working capital, they will get recovered. And how much was blocked into working capital? Rupees 2 lakh. So my terminal cash inflow comprises of two values, and that becomes a total of 2,50,000. So remind you, in the fifth year, apart from 1 lakh operating cash inflow, your terminal cash inflow will be 2,50,000. So we have taken step 1, estimation of cash outflow, which is 6 lakhs, 4 plus 2. We were given operating cash inflow, no calculation was required, and we have identified terminal cash inflow, salvage value 50,000, recovery of working capital 2 lakh, that makes it 2,50,000. Now what is left out? Applying the method, that is third step. So we can proceed further for applying the third step. Now if you see, this is the solution table I have created for you for payback period method. So we had initial cash outflow 6 lakh. In the fifth year, we will have terminal cash inflow. In the fifth year, we will have terminal cash inflow, which will comprise of 2,50,000. That means to say, in the fifth year, in total, we will have 3,50,000. Now, for calculating payback period, we need to make it cumulative cash flow after tax. And in general, when we make the accumulation, we might not consider terminal cash inflow. This terminal cash inflow will be considered in accumulation only when our cumulative cash inflow does not become equal to the initial investment. So remember, when you make the accumulation of cash CF80, keep on adding only operating cash inflow, add the terminal cash inflow only when we have not reached the target. So let us make the cumulative cash inflow 1 lakh by the end of first year. Then this 1 is added with 120. So by the end of second year, how much in total we have recovered with the help of cash inflow? Then this plus this, if we add up, it will become 370. This plus this, it will become 550. This plus this will become 550. And this plus this will become 650. Since we have reached the target, so only submission is that we need not to add the 250. Logic is simple. This 250 is bound to come only on the last day of the project, whereas operating cash inflow come in a flow every month, every day, because sales is generated every day, so cash inflow is also generated every day. So in that case, we have to now work out cash inflows have been calculated, only payback period. What is my target? Initial investment of 6 lakh. So that gets identified in the cumulative. So step is that whenever this kind of series of cash inflow is there, look into the cumulative cash inflow table or column, and where my target of 6 lakh falls. So it falls between 4th and 5th year. That means complete 4 years will be devoted. So it will take complete 4 years and some fraction of the 5th year. Now how much we have recovered? Complete 4 year will be devoted. Our target is there getting 6 lakh recovery. So in that particular one, how much has been recovered by the end of 4th year? 550. So we are running short of only 50,000 to make it equal to 6 lakhs. So payback period in this case will be equal to 4 years plus some fraction of the 5th year. Now what is that fraction? Find out how much is the deficiency to make it equal to 6 lakh, 50,000. How I got 50,000? 6 lakh minus 550. So that makes it 50,000 shortfall. And how much in total is coming in the 5th year from operating cash inflow? 1 lakh. So divide it by 1 lakh. So you get an answer 4.5 year. It means with the help of operating cash inflow, it will take 4.5 year to recover 6 lakh rupees. So that is the way payback period is calculated. I hope calculations are clear to you. Terminal cash inflow I have not included in cumulation. Reason being, my target gets achieved with the help of operating cash inflow. So terminal cash inflow will be included in the cumulative cash inflow only if operating cash inflow accumulation is not sufficient to recover my investment. So that is the trick to solve numerical on payback period. Now, since we have these values, we can first make an attempt for NPV and then IRR or PI, whatever method we are there. ARR we will attempt at the end. So let us see what discount rate was given to us. So let us proceed further to the previous one. Let us see what was given to us in the numerical as discount rate. It was 11%. So note down the discount rate given is 11%. That means desired rate of return, it may be cost of capital or hurdle rate or cutoff rate. So with 11% rate, we have to work out NPV and profitability index also. So now we are moving ahead with NPV method. So your initial cash outflow is 6 lakh. So present value of 6 lakh will remain 6 lakh. We have CFAT and now we will have terminal cash inflow also, which is 2,50,000. We have to find out PVIF at the rate of 11%. We have to find out PVIF at the rate of 11%. So it is 0.901 for the first year. If you have the time value table, you can use time value table. I am using the formula to work it out. For second year, it is 0.812. For third year, it is 0.731. For fourth year, it is 0.659. And for fifth year, it is 0.593. And same will be the factor for terminal cash inflow. Formula for PVIF, just for your convenience, I am giving 1 upon 1 plus R raised to the power of n. So we can calculate PVIF by using this formula. So we have PVIF either coming from table or from formula. We will get PV of cash inflow, present value of cash inflow. So 1 lakh multiplied with 0.901. So it becomes 90,100. Then 1,20,000 multiplied with 0.812. So 97,440. Then 1,50,000 multiplied by 0.731. So that becomes 1,09,650. Then 1,80,000 multiplied by 0.659. 1,18,620. And lastly, what we can do, we can club these two values. So in the fifth year, we are getting 3,50,000 multiplied with 0.593. So we get it. Combined value is 2,07,550. So just remember, I have added these two and multiplied with the factor 0.593. So we have PV of cash inflow at the rate of 11%. Now we can get sum total of PV of cash inflow. So this includes PV of operating cash inflow as well as PV of terminal cash inflow. So if we total it up, so that becomes 6,23,360. 6,23,360. So that was the second step, calculating present value of cash flow. Present value of initial cash outflow is 6 lakh. Present value of all the cash inflow is 6,23,360. Now we can calculate NPV. Formula for NPV is simple. Summation PV of cash inflow minus summation PV of cash outflow. That means to say our total PV of cash inflow is 6,23,360, and from that if we deduct 6 lakh, so how much we get it? 6,23,360 minus 6 lakh. We get a value positive 23,360. Since NPV at 11% is positive, we recommend project is acceptable as per NPV criteria. No cutoff rate is given, no cutoff value is given, and rather it is not required in NPV. That cutoff is required in IRR method. So as per NPV method, project is acceptable. So we have applied the second method. If we go for the third method, profitability index method, that means we will be taking the steps again, the same steps. Step number 1, estimate initial cash outflow. Step number 2, estimate operating cash inflow and terminal cash inflow. Step number 3, calculate present value of all the cash outflow and present value of all the cash inflow. These steps we have already done. So step 1, 2 and 3 are already done. Now only step number 4 has to be taken out. What is that? For profitability index we apply the formula. Now remember the values. I am going to take you to the next slide. 623,360 is the total PV of cash inflow and 6 lakh is PV of cash outflow. So profitability index, gross profitability index is gross profitability index, which is also known as gross benefit cost ratio. Sum total of PV of cash inflow divided by sum total of PV of cash outflow. That means to say 6,23,360 divided by 6 lakh. So it gives me a value 1.0389. So my gross profitability index is 1.0389. And as per the rules, whenever gross PI is greater than 1 or equal to 1, we accept the project. Similarly, this gross PI can be converted into net PI. Net PI is simple, gross PI minus 1. So it becomes equal to 1.0389 minus 1, so 0.0389. And whenever net profitability index is positive, we accept the project. So this is the way project evaluation is done under profitability index method. I will give you one more formula for net PI. Net profitability index is equal to NPV divided by sum total of PV of cash outflow. So what was my NPV? 23,360. And PV of cash outflow was 6 lakh. So use that value. You will get 0.0389 489. So apply either formula for net PI, you will get the same result. So that is the way we can apply profitability index. Now we proceed further with the practice on ARR, that is average rate of return or accounting rate of return. So under accounting rate of return, what we do? Step number 1, calculate average investment. So formula for average investment is like this. Average investment is cost of asset minus salvage value upon 2 plus salvage value and plus working capital. So that is the formula for calculating average investment. Now if we apply the values or plug in the values, cost of asset is 4 lakh, salvage value is 50,000 divided by 2 plus salvage value 50,000 plus working capital 2 lakh. So what result we get it? First of all, take the result of this particular part. So this gives me 3,50,000 divided by 2. So 1,75,000. And sum total of this is 2,50,000. So we get it 4,25,000. So my average investment in this project is 4,25,000. However, total investment is 6 lakh. So that was the first step. Then we calculate average profit after tax. Now pay the attention, in the numerical we are given CF80. And if you remember the formula of CF80, it is profit after tax plus depreciation. So CF80 is equal to like this. CF80 is profit after tax plus depreciation. Now we know the CF80 value. We can calculate depreciation simply. If from CF80 if you deduct depreciation, you will reach at PAT. I repeat it again. We are given operating cash inflow. From operating cash inflow, if we deduct depreciation, then we will reach at profit after tax. Now question is, how much is the depreciation? For that purpose, what we do, we can use straight line method. So whenever numerical is silent, annual depreciation value is cost of asset minus salvage value upon life of the asset. So what was my cost of asset? 4 lakh. Salvage value 50,000 divided by 5. It means anyone who has applied the depreciation, he might have applied a depreciation of 70,000 year on year. So what I need to do? I have to deduct 70,000 from each value. I have to deduct 70,000 from each value. So remember the things. Average investment is 4,25,000. Annual depreciation is 70,000. So from given cash flow after tax, we will simply deduct 70,000 from each year's cash flow, and we will reach at yearly profit of all those years. So now we calculate that. So what we have? So our average investment is 4,25,000. Now we calculate profit after tax. 1 lakh minus 70,000 120 minus 70, 150 minus 70, 180 minus 70, and 1 lakh minus 70. So that is profit after tax. Sum it up, summation PAT. So I hope it will become 3 lakh. You can verify using your calculator. So it becomes 3 lakh. Now we calculate average profit after tax, which is sum total of profit after tax divided by life. So it is profit after tax. So sum total of profit after tax is 3 lakh divided by 5, we get 60,000. So now ARR is average profit after tax divided by average investment. So what answer we get? 60,000 divided by 4,25,000, 0.1412, that makes it 14.12%. It means year on year, project is giving return on investment 14.12%. So that is the way ARR is calculated on average investment. However, if we are required to calculate ARR on total investment, then average profit after tax to be divided by total investment, which is 6 lakh. So it becomes 0.10, that is 10%. So by default, we calculate ARR on average investment. So this is the way we have practiced all those methods. Now, you might be requiring some practice on new type of numerical also. So I hope you have learned these methods, understood these methods. Let us proceed further with the next numerical. If you see this numerical, a plant is in use for last 3 years. It was purchased at a cost of 3 lakh. Its remaining useful life is 4 years, at the end of which it is expected to have a salvage value of 20,000. Working capital investment at time 0 was 50,000. Company is planning to replace this plant with a new one which will cost 2,50,000. That means this plant is already in use for last so many years, that is 3 years, and remaining life is 4 years. However, at this point of time, company is thinking to replace this old machine, old plant with the new one. And new plant will cost 2,50,000. New plant will cost 2,50,000 and has a life of 4 years. And new plant will have salvage value of 30,000 at the end of 4 years from now. Replacement requires additional investment in working capital of 15,000. If depreciation is provided on SLM basis and tax rate is 30% and cost of capital is 10%, should the replacement be done or not? And we have to apply method NPV. And further we are given, the replacement will result into incremental yearly profit before tax of 60,000. That means if old plant gets replaced, it will result into additional profit before tax of 60,000 and yearly increase in cash operating cost will be 8,000. So that is the way it is given. Now we will proceed further how to solve this numerical. Now one more thing is that what we can do, note down the figure and we will solve it out. Now step number 1 will be there in this one. Estimate incremental cash outflow. That means if today replacement is done, how much more out of pocket cost will be incurred. So that will be cost of new plant, which is 2,50,000 in this case. Additional investment in working capital. So I hope you remember how much was the additional investment in working capital. So we can check it out. How much was the additional investment in working capital? So additional investment in working capital will be 15,000 only. 15,000, and salvage value differences also we have to work it out. So 2,50,000 is the cost of this. 15,000 is the additional investment in working capital. Then less after tax salvage value of old plant, and we will get net incremental cash outflow. Because right now we are selling the old plant. Now old plant, we have to find out after tax salvage value. Number one, we have to give a tax treatment to that salvage value also. So total activity has to be done. So that we will calculate, and finally we will arrive at net incremental cash outflow. So keep into mind that we will do that also. Then comes calculation of incremental operating cash inflow. Incremental profit, incremental cash operating cost, add savings in cash operating cost, less incremental depreciation. So this is the list of activity to be done. Now what we have been given? We have been straightway given incremental profit before tax. That means these steps we need not to do. However, in a numerical these steps might be required. So that you have to take into consideration. Incremental operating cost might be given to you. That means how much more operating cost will be incurred. Sometimes there might be a savings in cash operating cost. That also has to be considered if it is given. And then incremental depreciation. That means difference between the depreciation of old machine and the new machine has to be taken into consideration. So all that has to be done. Then tax on incremental profit before tax, incremental profit after tax, and when you add the incremental depreciation, we arrive at incremental operating CFAT. And thereafter, we will apply the method. So this is the way when replacement numerical is given, yes, we solve it like this. So now quickly, I will take you to the numerical again. Now this is my numerical. So we have to find out how much is the book value of this plant which is in use. So book value is simply cost minus accumulated depreciation. So what was the cost of this plant? It was purchased at 3 lakh. So we are estimating book value. And accumulated depreciation, that means how much depreciation might have been provided so far. So its cost was 3 lakh. Estimated salvage value was 20,000. And original life is 7 years. That means in the past 3 years, every year we have provided a depreciation of 40,000. So in 3 years, we have provided a depreciation of 1,20,000. So book value as on the date of replacing this plant is 1,80,000. Now let us see how the book value will be calculated for this old plant which is getting replaced. If you see, book value is cost of the plant minus accumulated depreciation. That means depreciation provided so far. So far 3 years depreciation has been provided. So how the annual depreciation might have been calculated? So annual depreciation is simply cost of asset minus salvage value upon life. So cost of this plant is 3 lakh. Estimated salvage value is 20,000 and life is 7 years. So anyone who has calculated depreciation in this case might have applied 40,000 per annum. So in total in past 3 years, depreciation provided is 120. So resulting book value is 1,80,000 rupees. Now we have to find out what is the sales value of this old plant. So sales value, if you see, sales value of old plant is 2 lakh. That means on the disposal of plant, company is getting a profit of 20,000. So we have to find out after tax sales value of old plant. after tax sales value of old plant. So how much we are going to get? So cash realized from salvage value 2 lakh less tax on profit, less tax on profit. So on a profit of 20,000, how the profit of 20,000 comes? We are selling the plant at 2 lakh which has got a book value of 180. So difference is 20,000. We will pay the tax at the rate of 30%. So 6,000 tax will be paid, 30% of 20,000. So what will be the net after tax salvage value? 1,94,000. 1,94,000. So it will not be 2 lakh, but because company has to pay tax on that profit, so net realized value is 194. However, new plant is getting replaced for 250. So we have cost of new plant 250. Additional investment in working capital 15,000 less after tax salvage value, so that is 194. So that is being deducted. So we will get incremental initial cash outflow. So 265 minus 194, we get 71,000. So 265 minus 194, 71,000. That means replacement is costing me 71,000 rupees. That is initial cash outflow. Let us quickly complete the next table and we can go ahead. So next table is like this. We are given profit before tax. So year on year, profit before tax is increasing by 60,000. On that, tax will be 18,000. So we have incremental profit after tax 42,000. Then we need to take incremental depreciation. That means new depreciation minus old depreciation. So new machine costed me 2,50,000, which was having salvage value of 50,000 and remaining life of 4 years. So we get it 50,000 annual depreciation. Whereas depreciation on old machine was 40,000. So incremental depreciation is 50,000 minus 40,000, so 10,000. So finally we get year on year operating cash inflow will be 52,000. So initial investment is 71,000. Year on year operating cash inflow is 52,000 for 4 years. And then we have incremental terminal cash inflow, which is salvage value of new machine 50,000 less foregone salvage value of old machine, which is 20,000. So finally we get 30,000 as incremental terminal cash inflow. So this is the way we can estimate cash inflow. Now method you can apply, there is no problem. Use the given discount rate, use NPV method and calculate NPV. If NPV is positive, project will be accepted. If NPV is negative, replacement will not be accepted. So this is the way we work out different methods, different cash inflow, different cash outflow. I hope you have understood the concept. Thank you so much for giving me your time.